Hello, welcome back. This is John Hind, Compass Resolution, talking to Mark Jones, financial advisor. In this video, Mark, I really want to talk a little bit about terminology. And in fact, I've got 4 questions I want to ask you. The first of which is this. Can you explain, in layman's terms, if you would please, what a pension based on value is?
So, yeah, I think you spoke briefly in your last video, John, that terminology is big in our industry. There's lots of different names for pensions, but pensions based on value is what you've been saving into yourself, into your pension plan since when you started. How much growth you've had, less any fees or charges that have been taken out of that plan. They're generally known in the industry as a defined contribution. So what you get out at the end is only defined by what you've got out, what you've put in, and how much it's grown by. And these come under a lot of different names: a SIP, personal pension, defined contribution contract, an AVC. There's multitudes of them, but that's basically what it is. You don't know what you're going to get until you get right to the end and your savings stopped, and then you're going to take benefits from it.
Okay. So, I mean, I guess a lot of my clients have these kind of a pension of some kind of personal pension nature, whether, as you say, it is a SIP or self-invested personal pension, and so on. The next question I've got, well, the second question of the 4 questions I've got for you is this, and again, in layman's terms, if you would, I've heard this, all my clients have this notion of a guaranteed, or this kind of terminology, guaranteed benefit pension. What's that?
So that's what you're talking about there is called a defined benefit or a final salary plan. So again, you've been working for an employer for some period of time. Your employer would have been paying into the plan, and so would have you. And rather than the plan being worth X, which is variable and you don't know what that is until you actually get there, the final salary contracts are worked out on what your contribution is over the amount of years you've been paying in, with a definite outcome at the end. So lots of variable factors around how that's calculated: average salary, average career salary, best salary in the last 3 years. The contracts are different, but basically you'll get to the end of your working life with an employer. You'll then join their final salary scheme, so they'll then start paying your pension income, and that output, the amount of money you take each year, is defined by the contract that underwrites it. So that generally looks like, for some contracts, there'll be a tax-free amount, which generally won't be 25% of what the fund is, but there'll be a tax-free amount that's paid to you as a lump sum, and then you'll get an annual income paid monthly direct from the employer or the administrator for the employer.
I like the idea of a guaranteed pension when time comes. That sounds better than the uncertainty of the other pension. Anyway, moving on quickly before we get down that particular road. When couples get divorced, they are required to get hold of this thing they call the CETV. Can you help us understand a little bit more about that and things we ought to be bearing in mind when we look at this figure, the cash equivalent transfer value? Yeah.
So the cash equivalent transfer value is related to the final salary or the defined benefit contribution. So as I've just mentioned previously, when you stop working for an employer, you'll get an annual income paid for life, which it'll escalate at certain levels depending on the contract. Normally it's in line with inflation, but you can also get some fixed rates. But behind that, so say for example, I'm a 65-year-old man, there'll be a life expectancy around me as a member of that scheme, which may be 20 years. So if they're going to pay me £10,000 a year for 20 years, increased in each line with inflation, then there's a pot of money that sits in the pension scheme that's there to pay that. So if I wanted to leave the scheme today and not actually get my guaranteed income for life, I can request a transfer value. That's a pot of money that the pension scheme wants to give me to transfer it away to another personal pension where I carry all the risk and I lose all the guarantees. It's important to understand that for some schemes like the NHS, the fire, the police, the armed forces, they don't allow you to transfer away that pension because really it's not a funded pot. It's the government take taxes from people that are working every single month and they pay out for these pension schemes. So whilst you might get a value for the calculation, you're not able to physically take a lump of money away and put that into a personal pension.
Yeah, that makes sense. Yeah, that's really clear, actually. Thank you for that. And that brings you on to the kind of final question of this kind of 4-question video. Should my clients be paying for a recalculation of the cash equivalent transfer value by an actuary? Is that worth it?
It can be quite expensive to do that, really. If you're looking at these reports, they can be in excess of £3,000 to £4,000. And in our opinion, and it is just our opinion, it's not the industry's, it isn't really worth paying for that, because the pension scheme will actually have a rule which sets the amount of inflation, the amount of rates per year, escalation in payment of these pension plans, and all that's devised by someone external to the pension scheme, an actuary themselves, who's actually done the calculations. Now, as part of our review process, we will review whether we think the cash equivalent transfer value is right, but we wouldn't generally challenge it on the basis that the actuaries use different variations than ourselves. So in my opinion, it isn't worth paying the actuary to actually get that calculation done.
What's the point anyway? I mean, is it likely to be significantly different than the cash equivalent transfer value?
Well, actuaries in the pensions industry will have their own view on how that pension should escalate, either pre-payment or whilst it's in payment. And when they run their own calculations with their own software, the cash equivalent transfer value that they get may be significantly different than the scheme, but the scheme will have its own rules, and therefore the actuary that's working on behalf of the pension scheme will have used those scheme rules, which may be not what the pension actuary is using. So we generally find that 99.9% of the time the CETV that comes out of the scheme is correct, and it's not really in your interest to pay a large fee unless you've got pension benefits over £1 million. Then it may be possible to do that.
Okay, well that's really helpful. I know in the next video I want to ask you more about the kind of valuation process itself. So, unless there's anything else you want to say in this particular video, should we move on to that next and third video talking about the valuation process? Is that right?
Yeah, let's do that, John.
Great. See you soon.